So I'm here with Matt Smith, and today we are unveiling our research on Aehr Test Systems, which Matt co-authored with me, and he essentially is doing an update. Aehr just reported earnings recently. They had a pretty good first half to their fiscal year. And Matt, welcome to the video. It's Matt Smith from Good Soil, but he's also joined the Halter Ferguson team.
Thanks, Bradford. Yeah, happy to be doing this. And I kind of started my career in not necessarily equity research, but like financial valuation, which was essentially the same sort of thing as equity research. So, Aehr was an interesting one to dive into. I kind of approach each one of these companies in a neutral manner. Like I'm not really sure what I'm going to think about them when I dive into them, and like Aehr is admittedly a very complicated kind of industry and product that they offer. It's like a small company in terms of market cap. The service they provide is like very niche, so it's kind of easy to either just dismiss it or like say it's not worth digging into. But the more I dove into it, the more I was kind of just blown away by their competitive positioning.
Yeah, it's pretty crazy. We'll get into that shortly. I'm going to share my screen and show our disclaimer real quick. So I am a financial advisor. Halter Ferguson is a financial advisory firm. We're in Indiana. That's our disclaimer there. So let's get right into it. At a high level, what's interesting about Aehr Test Systems is their product is needed for making what's called silicon carbide chips, which are used in to deliver power to the motors in electric vehicles. And silicon carbide is what Tesla is using to help get them a range advantage over their electric vehicle competitors. And what's tricky about silicon carbide is the third hardest substance on planet Earth, and it's very hard to make, and you have to bake it in an arc furnace, which is kind of nutty. Anyhow, like because it's hard to make and all these things, it's hard to get a very good yield on your silicon carbide wafers to make these chips that help deliver the power to the electric motors. And what Aehr does is they make these chambers where they can test the wafers that come from the chip maker, and then they burn those in for 10 hours. So they subject them to extreme temperature and maybe different voltages, and then they test them again, see which of those chips or devices failed over that 10-hour burn in. So what Aehr offers that's different is instead of just being able to load one wafer into that machine, they can handle 18 at a time. And their product costs it costs a $4.5 million investment for 18. So essentially it gives them it gives a chip maker $250,000 per wafer of capacity with the burn-in, whereas the competition is at $700,000 to $1 million per wafer. So there's this enormous cost advantage going with Aehr Test Systems. And what's kind of funny, and you notice this in your research, Matt, is they were kind of a secret, or for some reason they had a hard time getting the word out. Like Stmicro is a clear leader in silicon carbide, and they didn't even use Aehr Test Systems when they got ramped up.
Yeah, like the whole kind of recent history of this industry was just kind of like a head scratcher. Like, why is this like a secret within the customer base? Like, so this silicon carbide methodology was first used on the Model 3, and they realized that it had this like huge range advantage. I think it's somewhere in the neighborhood of 15 to 20% increase in the vehicle's overall range just by using silicon carbide in the traction control motors. So like that's a huge benefit, but like for some reason it was viewed as a pretty big risk at the time that Tesla would try this. So you've got kind of that range advantage, and it seems pretty clear that like the whole industry is going to have to move towards this stuff, because you don't want to take like a 20% range hit just because you're using like the wrong semiconductor. So like that seems pretty obvious, but then when you get into Aehr's positioning here, like even a lot of the customers who were using silicon carbide just weren't aware that you could actually test 18 of these wafers at the same time, like you mentioned. And not only do you have the kind of cost benefit that you outlined, but I mean, imagine you're one of these semiconductor companies and you've got like a very large kind of ramping business of EVs, not just Teslas, but all the other companies that are really trying to ramp up this volume. Like having a high throughput in a reasonable footprint within your factory space makes a lot of sense. And so if you've got like a 10-hour burn-in, which is a very long amount of time,
yeah, that's a big bottleneck.
that's a huge bottleneck. And so if you're trying to do, I don't know, tens of thousands a year or something like that of these wafers, like you can't just have unlimited floor space and just kind of continually increase that by 50% per year. It's just impractical on a lot of different levels. And so like the fact that you can actually do 18 at once, and that is like entirely patent protected, like nobody else can even do this because they've got all the IP surrounding it. They really just are in this really unique position to take advantage of the huge kind of macro trends in EV adoption, but to do it at really good margins while still providing incredible value to their customers. So to me, it was like a no-brainer the more I dug into it.
Cool. Well, let's show people the research we've done. It's kind of a cool report that you came up with. So I'm going to share my screen again. So I just want to give people a taste. We've shared this out on Twitter. It's not quite on our website, but we'll put it up on our website soon. Let's see, Zoom's going to get in the way a little bit, but let me try and do this as a slideshow so people can see. What are you seeing? Are you seeing the presenter mode?
I'm seeing the presenter view, yeah.
It's showing the one on, let's see. Can you see it now?
Yeah, there we go.
Okay. So we got Matt's write-up. We try and explain silicon carbide. Again, like, don't let this area intimidate you. What people need to focus on when looking at this company is they have this huge cost advantage over their competitors. And when you have such a huge cost advantage, then it's essentially you can price the product how you like. And what's funny about how Aehr is pricing the product is they don't want their customers to try and reverse engineer what they've done. Their competitors cannot because it's patented. So they're pricing it so that their customers are incentivized just to buy from them instead of trying to reverse engineer it. So it is patent protected. Gain Erickson, he's the CEO of Aehr. He's been in the burn-in and testing industry from both package parts, from when you put it on a motherboard, put all the parts on the motherboard, and on a wafer level. The industry's moving from package part testing and burn-in to wafer level. It's just more efficient that way. On this page, there's a picture of an inverter for Model 3. I think this is a bit dated. I think it looks different now, and possibly instead of there being 24 silicon carbide MOSFETs now, maybe there's 48, or maybe it's two-sided. And what we found out from our checks with tier 1 automobile supplier is that a bunch of them are moving to silicon carbide. They want to get that range advantage. Battery prices have gone the wrong way recently, Matt. So yeah, there's quite a bit of savings, even though silicon carbide adds about $700 per car, and GM and others may have been resisting using it. they're using it now. And so what we feel is going to happen is, you can see on the bottom left part of this chart, this is what onsemi did with Aehr last year, is about $40 million of their revenue. So there's a big risk with Aehr where one customer was 80% of the revenue. So normally people will just like stop looking at something.
Right.
And that would be a risk if Aehr was not adding more customers, and if onsemi wasn't continuing to order aggressively from Aehr. And essentially, like once you find out about Aehr's product, it'd be you almost need to get fired for not using them if you're
Well, that's kind of what's interesting though. Like if you look back at their historical financials, which we didn't really show on that chart, but you know, they were a much smaller company, you know, just a few years ago. So like if you look at the, you know, the quarter back in August of 2021. Oh no, that's the financial strength. So sorry, that's but the previous financials were much smaller than where they are today. So yeah, there it is, the revenue. So like August of 21, they were doing just like 5 million of revenues, which is, you know, like pretty small. Then onsemi comes on the scene.
That's basically
and
one order too. It's like one fully kitted out system is $4.5 million.
Yeah, exactly. And so they, you know, they were just kind of humming along, like doing their thing. You know, they were just in this really kind of obscure niche space. And then onsemi kind of stumbles upon them and realizes like, oh, this actually makes a lot more sense. It's way more economical for us. We need to scale like crazy to get to the levels of silicon carbide that the industry is going to need by 2030. And so this is both cost effective today, and it's the only thing that makes sense for scaling to like these roughly 25x projections of how much silicon carbide the industry is going to need by 2030. So like onsemi just came and said, oh yeah, we'll like we'll be way more than, you know, 50%. I think they disclosed it was like 80% of their revenue in one of the recent quarters. But that's just because like the product makes so much sense. And what they're finding now is that other large semiconductor customers are coming to them also and coming to the same conclusion that onsemi came to, and just said, okay, well, I guess we need to order like massive amounts of your products now because this is clearly the best. And we just had never heard of you or didn't think what you were doing was possible. And so it's just like a strange kind of market inefficiency that was in effect for a while there.
Yeah. And I suspect with Stmicro, there may have been a bit of a European bias where they're based in Europe and they ended up going with an Italian supplier of this burn-in equipment. I think their name is IDA or EDA or something like that. So let's get into how we kind of view the base bull and bear case. So we mentioned that onsemi was about 40 million of revenues, and what we're essentially doing is just conservatively assuming that onsemi is going to kind of keep what they're ordering from Aehr Test Systems about flat, and that Aehr is going to be adding more customers as time goes on. So what the base case does is it assumes that Aehr signs up 4 major players. So it would be onsemi would be included in that, so 3 more. And essentially what Aehr's already announced is that big player number 2 is already starting with them. That's Wolfspeed, and their specifications that they're wanting from Aehr are different. So you can kind of tell in the press release when Wolfspeed is ordering versus someone else. And then there's this other company just coming out of the blue where they aren't even listing silicon carbide on their website to automobile customers, to the car makers, and like they're just coming out of nowhere, and their plan is to become a top 5, top 3 player in silicon carbide. So we feel like Aehr it's fairly in the bag, or fairly realistic to assume that in total 3 more players are going to show up to the table. And that's what this base case is modeled off of. Any comments here, Matt?
No, I mean, just to kind of reiterate that, like, the on semi coming on and being such a large concentrated customer is indicative of a trend. It's not a concentration risk, because that, as more large customers come on board, like, that concentration will naturally decrease. But like, the more important story is just like, onsemi is actually ramping. So are all these other customers. There's consumable sales that come along with this as well over time. So which are higher margin. So when you just start like extrapolating this stuff, and we didn't really talk about their operating leverage either, but like, that's very apparent, just how like, they're targeting 50% gross margins, and like, their operating expenses don't really ramp with their higher revenues.
Which is good. You don't want the costs ramping with it. So yeah, if you look at August of 21 versus 22, the revenue went up quite a bit, and the operating margin went up with it. And the quarter ending November, again, revenues went up and margins went up. And what they just announced in their earnings that are accompanying this quarter end is that over the first half of this year versus first half of this year, revenues went up 60% and earnings have tripled.
I mean, that's what you want. Like, it's so crazy. And this is a question you asked on I think the earnings call 2 quarters ago. It was kind of like honing in on their contribution margin. So for every incremental dollar of sales, how much of that flows through to the gross margin line? And it sounds like that answer is 60%.
Yeah.
So if you start thinking about like increasing sales by 5x over a couple of years, and what that's going to do to gross margins. I mean, they're already getting pretty close to 50% gross margin for this year, which is like a ridiculous step up from where they were. And by all accounts, that seems to be very sustainable, and the operating expenses don't grow with that. It's capital light because they're using contract manufacturers. So it's not like there's some huge drag on cash flow that, to support this rapid growth. Nope. It's like almost all incremental free cash flow at really high margins, at phenomenal operating leverage. So the whole story here is just like, this really is a gem. The example you used, Bradford, on your initial research report that you published back July, was like, this is a silicon carbide gold rush. So like, this is an industry-wide thing. More silicon carbide is going to be used. And I think you want to invest in the company that's selling the picks and the shovels, like the only picks and shovels shop in town to support this, like that. And that's what Aehr is in my mind. And it's just such a good analogy, I think.
Yeah. Yeah, and it's almost like they're supplying the drills. So like the other competitors are supplying the picks and shovels, and Aehr
That's true.
the heavy equipment. Yeah,
that's a really good point. Yeah, so it makes your customers' economics that much better. But like, they also don't make the drills. They're just like shipping in the drills from the East Coast somewhere at a 50% margin. It's like, it's just such a unique business. Like, things like this seem like they shouldn't be able to happen. I mean, it really is. I went from being completely neutral when I first started this, and it was a lot of research just to understand and get over the technical hurdles, because this is a really niche and technical space. But once I got over that and just kind of understood that the position they were in, like, oh my gosh, it was just like this light bulb. Like, this is like a hidden gem. So I got incredibly bullish on it after I, spent the many hours digging into this.
Yeah. And so the big idea with Aehr is that the main use of this right now is for silicon carbide. There's some other uses we can get into by the end, but what is driving silicon carbide again is the tremendous growth in electric vehicles. And essentially, what we saw globally last year was that electric vehicles still grew, not just Tesla, just combined, 50%. And if we didn't have the lockdowns in China, it was probably closer to 60%, because that essentially took like a full month off of, all the factories and all the shipping and all that. So in the year before it grew 100%. So you're riding that EV growth, but then the silicon carbide chip makers, like they don't know how they're going to supply all those chips, and they're trying like heck to ramp their factories. Wolfspeed's building a factory in New York, and we could read about these factories that are going up, and Infineon's building a factory in Malaysia, 2.4 billion 2024. On's probably going to be working on some more factories soon. And you have all these other players coming in. So that's where that future growth is also coming from, is not only are you adding customers, but here's why these companies are doing the heavy investment.
Yeah, no, absolutely. And I mean, not all those EVs that were sold last year even use silicon carbide.
Right.
Like this is a relatively new transition that's happening within that space. And when you think about the trade-off, if you're, a GM or a Ford or whoever that's making an EV, and you didn't choose to use silicon carbide before because it's an extra $700, and that's like on already very tight margins, that doesn't make a whole lot of sense. Well, when you realize that there's a 15 to 20% range benefit, I think it was 10 to 15% actually. So correction on that. But on a 200-mile battery pack, that's an extra 20 miles. Like I can't think of a more value added to the customer use of $700 on an automotive application or on the EV than getting an extra 10 to 15% of range. So to me, it seems very obvious that they're going to have to kind of convert to this technology. And if you're using a dual motor, then you get like double the amount of MOSFETs that are needed and that need to be tested. So there's a lot of reasons to be kind of bullish about this opportunity.
And again, one of our checks with a maker of the inverters showed that at least 5 of these major brands are moving to silicon carbide. And I think I understand why they didn't move it too quickly. Tesla is a leader, so obviously they're going to do stuff like this first. But I think the main reason why other players weren't using silicon carbide and were just using normal silicon was because they were only going to make 50,000 of a given model.
Yeah.
And what they're finding is they can't make any money making 50,000 of a given model. And in fact, they might be losing money on it. So they got to make more, and they have to compete more. They can't just depend on someone who's going to buy a Mercedes every time or a BMW every time. So they're going to have to compete a little more on range moving forward as EV penetrates the global car market. Let's show the bull and the bear case real quick, and then maybe we move on a little bit. So again, the on was about 40 million. So then we assume on the bull case, if a total of 6 companies, including on, are using Aehr, and then there's an additional 20% of revenues from consumables or smaller players, things like that, then that's what makes up our bull case. For them to get to this level would be fairly Herculean, but it's possible. If you listen to the CEO on these earnings calls, like there's everyone, he says every player is looking at Aehr Test Systems, and his compliance tells him not to say that either. But so we're assuming that a multiple that's half of the growth it would take for them to get there, when we're looking at this valuation. And then on the bear case, we're assuming lower incremental margins from the fiscal year ending last year, and because the growth would be lower to get there, the market would award them with a lower multiple. And there's no guarantee that if they do any of these scenarios that the market's going to value them at a certain multiple. or that they'll have a certain level of earnings. These are just hypotheticals. These are just scenarios that we're looking at when trying to value Aehr Test Systems. I think what you found, Matt, over a longer time, you were looking at a model where you were modeling 2030 what the business may look like, and we assume that equipment sales would be lower, but that they would be selling more of these consumables, which are their test blades.
Yeah. Yeah, which is kind of interesting, because then you could have like a decline in revenue potentially, because you're selling, you know, fewer of the system. So once this kind of crazy 50% compound growth in EVs winds down, and there's kind of the mass market is already there, then the growth rate obviously just kind of falls to a more normal level. And then you're selling replacement machines I forget what the useful life is, but every several years. And then just selling the consumables. So there is I think a reason to look out into the 2030 timeframe, and even if they execute like crazy, it stands to reason that the multiples might decrease. But the one thing that we didn't really talk about too much, which is like kind of like a Super Bowl case, is that there's all these other applications, you know, probably especially around solid state storage, which could be a whole other leg of additional growth above and beyond the EV range.
Yeah, so it's if they were able to automate testing, and these solid state memory providers could test 18 wafers at a time, they may not need to do as much burn-in, but they would, you know, want to test them and load them in an automated fashion. That would really help these solid state memory providers. There's also an application in what's called silicon photonics, where instead of the electricity going through a circuit, you know, traveling along the metal, it's the signal that the computers want to convey to another portion is conveyed through light, and that's called silicon photonics. And there's these different colored lasers, and burn-in is important for that. So if silicon photonics was much more adopted, that provides an additional upside scenario where Gain was talking on the recent call, like it could be like 100x or something.
Yeah.
But like, we're going to be evidence-based as investors. So until a solid state provider actually orders from them and starts to ramp, we're going to be cautious and skeptical about that. Same with photonics. If their photonics business did do well this last quarter, but we're going to wait till, it starts to happen and starts to grow more. Here we're talking about some of the risks. The other risk I would say with this business is that it's pretty binary, their sales. Each fully loaded system is about 4.5 million. And customers don't necessarily get that every time. They may get a full system, but then get like 9 testing blades to start out to test it out. And but if you think about 4.5 million for one order, last year they did 50 million in revenue. So essentially, if all the things were full order, that's like 12 orders. So that's kind of binary when they make a sale and they have a customer concentration. So those are some different things about it. Any other misconceptions you think or things that we learn you think we should cover?
Yeah, I mean, I don't know about misconceptions maybe, but the one other thing that really struck me as I was digging in and listening to a lot of the company presentations and earnings calls was, this is the kind of horse you want to get behind with their CEO, Gain Erickson. Like, this is a super technical guy who's been in this industry for decades. He's
over 30 years, and he started with Hewlett Packard when Hewlett Packard kind of ran the old computer industry.
Yeah, exactly. So like, he clearly like knows this industry inside and out. He's incredibly well connected with all the players. But like he's also just a very decent human being. Like he talks about wanting to be fair with his customers' pricing, and you can tell from the way that he says it that he's just genuine with his words. So he's like a respectful, honest, like incredibly competent leader. But at the same time, he's like brimming with enthusiasm over all these opportunities, and he's like,
Mhm.
you can kind of hear him like throttling back his excitement on some of these earnings calls, like this opportunity is 100 times bigger, but and it's a little pet project of mine. I want to make it work, but we're not baking that into our base case. And he talks about them getting to 40 million of sales per month, and like how they can do that with very little incremental costs, and like how the market opportunity is there, but they're not baking it into their base case. And so he's and then like on the last call you alluded to, he was talking about like all these like detailed physics things. I forget what it was, but it was like about like the mass of like a photon, or how a photon doesn't have mass, and like the wavelength and all this stuff about physics. And like this is really technical stuff that he clearly understands at a very deep level. So it's like the right combination of technical expertise, personal integrity, incredible leadership skills, and like a guy who understands the market opportunity and understands what this investment thesis looks like, and
Yeah.
can really execute to get there. So he really impressed me, and I think you can have an opportunity like this, and if you've got the wrong kind of horse in this race, like they could fail on execution. So having him there really gives me a lot of confidence on their ability to execute on this really lucrative opportunity.
Yeah. He's not only a good fiduciary for the business, but also his customers.
Yeah.
The customers are trying to shorten the burn-in time. Like they're like, oh no, we don't have to do 10 hours. We want to do it in 6 or less. And what Gain then shows them is they'll take a wafer from that customer and show them, okay, here's how it's behaving after 6 hours. Here are the devices that have failed. But if you do 4 more hours, there's these other devices that fail that would have failed in an electric vehicle while someone was driving, and potentially caused an accident, caused some unhappiness from whoever you're supplying the inverter to. So yeah, I think I agree with you. He's a good person to have, and a good horse to have. Let's talk a little bit about your history with a power provider. It's an asset business where I think you were on some projects where you essentially ordered a wind farm from GE, and you helped with the financials of figuring out, what does that look like, getting it installed. Talk a little bit about that, and then how that might relate to another use of inverters, aka the Tesla Megapack. We'll switch gears from Aehr for a little bit.
Yeah, sure. Yeah, so my background when I started my career was in finance, valuation and investment banking, but then I moved to the energy side. So I was working for a utility for a couple of years, kind of doing a lot of different things in finance and kind of risk management. So like really my job was to like bounce around to all the different areas of the company and like identify risks and kind of like plan on how to handle those. But then I moved to the non-regulated utility part of the business. So that's like power generation that is not a regulated utility. So it's like actually market-based competition. So yeah, I was in that business for a couple of years, and we made the decision to move very aggressively into renewables. And so one of the first projects that we got involved with was a wind farm that was under construction. So I wasn't, necessarily ordering the turbines from GE, but what I was doing was, looking at all of the commercial components of the entire project. So, all the contracts that we had with GE, and there are a lot of different contracts, which we could get into, looking at like the contracts that we had with landowners, and putting all of this together in a financial model to kind of say, okay, does this project make sense to go forward with? What do the economics look like? So, that I was doing that for a couple of years. Once it became very close to going operational, they tapped me to actually lead the asset management side of it. So that's kind of getting out of business development and say, now that this is an operation, you're in charge of kind of overseeing all of the basically act as like the business owner representative for the entire thing. So managing all the community relations, like the economic performance, all the financial reporting. We had over $100 million of project debt on this. So the bank relationships that went with it and all like the financial covenant reporting and regulatory stuff. So all that kind of like built out that functionality from the ground up. And
I
then,
think
yeah,
there was one time I reached out to you and you're like, my internet's a little spotty. I'm up in a turbine.
yeah, I climbed towers a couple times, like was working with the GE guys. Like the one thing I really liked about the power business is like spending time with like the blue collar guys on the plant is like awesome. I really loved that. So yeah, climbing towers.
How
like,
big is it inside one of these things?
the nacelle, so that's called the nacelle. It's about the size of a school bus. It kind of depends on what size turbine you're looking at, but the turbines that we had were 2.5 megawatts each, and so it was just about the size of a turbine. But you've got like the entire generator is inside there, plus a lot of like pumps and ancillary equipment and stuff like that. So it's like it's big, but it's also pretty cramped just with all the equipment that's in there.
Cool. So when it comes to Tesla Megapack, like when you were with this company, the sale wasn't technically completed until the juice was running from the windmill to the grid. Is that right?
Yeah, so I think and we did, just to fast forward a little bit, and then I'll get back to that. But we did add a battery right around the time that I was leaving. So I was involved in like the kind of quote process, and like I did all the economics of what is this battery going to do to like our financial impact from a site level. And so like that was added a little bit later, but it really does change the economics. But yeah, getting back to like when do you kind of recognize the the revenue, and does the juice have to be flowing? So like GE, for example, there's a couple different contracts, and it's very similar to Megapack. So there's like the procurement contract for the turbines, and so they're building these things in a factory, and then they've got to ship them. So there's kind of these progress payments along the way that you have to make just to kind of keep the spice flowing to the site. And then, but once like everything's there and kind of erected, there's this process of like making sure that everything is working properly. And I can tell you things do not work properly, like right off the bat. So there's fixes that are needed, and then you get to this point where you're selling what's called test energy. So you're just kind of making sure that like everything seems like it's working on paper, but let's like actually sell power to the grid and like make sure that's all working, and all the communications instrumentation within each turbine is working, and like all that sort of stuff. So that's for a couple days or weeks, and then finally you say, okay, yeah, I sign off that everything is done, and that's when you kind of release GE or whoever the equipment provider is from kind of continued obligations to be on site, and so then they can recognize all their revenue at that point, or at least the balance of it.
Okay, let's talk briefly about Tesla Megapack. So
yeah, I'm digging in.
So you're working on a report for Halter Ferguson Financial. We'll work together on it. We're looking at Tesla as a quote unquote car company with FSD that adds to margins, but we're not adding robotaxi, not adding Tesla Bot. But what we are going to look to do is try and model in something for Tesla Megapack. Looking at different levels of margin and profitability and scale of that. There's a cool video on the Tesla Megapack getting installed here. So we are you and I are actually traveling to California next week, next Thursday.
Wow, yeah, that's coming up fast.
Yeah, and so we're gonna stop by the Tesla Lathrop Megapack factory, try and see what kind of rate they're spitting out the Megapacks, and I'm looking forward to what you come up with on your report. I think you said you confident you can model something. What was it?
So I've been thinking about this for years. I mean, I used to have a YouTube channel devoted to Tesla Energy, where I was like thinking through all this stuff in
Yeah.
detail.
And that's called Spark Spread, and I was an actual Patreon of yours.
Yeah, you were a supporter back then, but I thought we did some pretty interesting stuff because it's a complicated industry. It is. So I was a generalist my whole life, kind of before going into energy, and I got into energy and my head kind of exploded. I was like, this is, you can't just like stumble into energy and like think that you can understand how it works, especially like electric utilities. Like it's just a completely different ball game. Like economics are way different. But anyway, yeah, so like I was looking at this, back then, and the opportunity always seemed to me to be on the hardware side, at least in the short term, but the profits were never quite there, and for a variety of reasons, Lathrop ramping being the most important one, but also all the price increases, and then the IRA, which is really going to boost demand. Like all these things are kind of like coming to a T at the same time. And there's been a lot of good conversation about this on Twitter. So, this is not all kind of original to my brain or to yours, Bradford. But I do think just this morning, I got really excited about, I think I finally understand how to like put the pieces together for a very credible, neutral assessment of like what the near term, call it 2 to 3 years out, profitability can be. So that'll be original research, and I'm really excited to get that done. It'll take some digging and scraping, but that's what original research needs.
That's your tease, people. Thanks for joining us, Matthew. I do want to share my screen one last time. Halter Ferguson clients and employees were holders of shares and or options of Aehr Test Systems as of January 10th, which was yesterday. We also own shares and or options of Tesla, so we stand to benefit materially from any meaningful increase in the share price. Thank you, Matthew. And looking forward to other original research we're working on. So we're working on Tesla. We're also working on Lovesac. So we'll actually have more of a formal Wall Street type research. What we're doing is fairly unique. We're what's called buy-side analysts. So we buy the securities for our clients to own. And normally it's sell-side brokers that are creating this research, but we want to put it out there, share our thoughts with the community. Anyhow, it's been good to join you all, and thanks again, Matthew.
Yeah, thanks, Bradford. Looking forward to a lot more of these collaborations going forward.
Yep. Bye for now.